So let's kick off this webinar. Good afternoon and good evening, everyone. It's great to see people join us from different parts of the world. Thank you for being here with us today. We are here to discuss a topic that we think it's not only timely, but also highly relevant: how to reduce hedging costs. Specifically, we'll focus on managing interest rate differentials and collateral requirements. Let me quickly introduce myself. My name is Matheus Zani. I'm a managing director at Diaglo, where I lead the risk management group with over 10 years of experience in the FX industry. I have advisory clients on structuring and executing FX hedging strategies, covering over $5 billion US across Latin America, Europe, and the US. Sorry, just allow people join us here. There you go. I'm also joined today by my colleague Albie Manderson. Albie is an FX risk management associate at Diaglo, specializing in tailored hedging strategies for private credit funds in North America. I'd like to quickly share the agenda with you so you know what's coming up. We'll cover a few key topics during the presentation, and we'll save time at the end for a Q&A session. So if you have any questions as we go along, please feel free to note them down, and we will address them later. Let's begin by introducing Diaglo. Diaglo is a technology and advisory firm founded in 2019, specializing in foreign exchange risk management solutions. We work with asset managers, investors, and companies worldwide to help them navigate currency exposure effectively. In short, we empower our clients with cutting-edge solutions to simplify the complexities of global financial markets. So now that you have a sense of who we are, let's dive into our global reach. Diaglo partners with a diverse range of clients worldwide, including leading private credit funds, private equity, venture capital, real estate, and infrastructure funds, along with global international investors. We also work very close with their portfolio companies with a particular focus on the energy, manufacturing, and fintech sectors. Geographically, we have a very strong presence in the US and key emerging markets such as Brazil, Colombia, and Mexico. Since 2020, we have supported over 50 clients and managing more than $5 billion in FX flows. This reach underscores our commitment to delivering innovative and impactful solutions in FX risk management. Moving forward, the question is, what makes Diaglo ourselves stand out? We offer a unique and comprehensive value proposition built in three key areas. The first one, sorry, let me enable the pen here. The first one, the technology expertise, or sophisticated tools leverage machine learning and advanced algorithms to deliver actionable insights and data-driven evidence. The second one, the risk management expertise. Now, over the years, we have developed deep local expertise in structuring hedge share classes, portfolio hedging, cash flow hedging, and also, of course, delivering tailored training session for our clients, the educational part of your job. And finally, the execution marketplace. We connect clients with a diverse range of FX counterparts, providing access to liquidity facilities and full transparency to ensure seamless and efficient execution. So this integrated approach empowers our clients to confidentially materialize their hedging programs and protect their margin profitability. That being said, I want to take a closer look at our technology very quickly. Our tools provides data-driven insights, as I mentioned, and also unbiased hedging recommendations tailored to your strategy and risk tolerance. So I want to highlight 3 tools today: the strategy simulator, the margin simulator, and the exposure management. Through the strategy simulator, clients can analyze and quantify risks, identify optimal strategies, and assess costs to minimize both risk and hedging costs. The margin simulation, clients can manage liquidity by evaluating the likelihood of margin calls and the size of these events. And finally, the exposure management allow you to centralize your exposures, your trade positions, enhance KPIs, your metrics, and produce clear and actionable reports for all stakeholders: the commercial team, the treasury team, the back office, and the C level and senior executives. And more importantly, this tool enables you to get rid of multiple Excel spreadsheets. Now, let's dive straight into the main topic of this webinar, which is hedging costs. Is one of the reasons that you join us today. So when we talk about hedging costs, it's essential to understand that they consist of 6 key components. Understand each one is crucial for managing them effectively. We have here the spot rate. This reflects the bid and ask prices for the currency pair. The gap between the ask and prices, it's also known as the spread, but please keep in mind that this is the gap between the rates and not the markup cost. Markup cost is another component, is another box that we're going to discuss later. So the size of this gap is defined by the level of trading activity on the currency pair. Therefore, the greater the trading volumes, the narrow they spread. And conversely, the thinner the volumes, the wider they spread. So by targeting periods of higher market liquidity, we can reduce these spreads and optimize costs. The second box here, forward points. This represents the interest rate differential between 2 currencies. And in my view, this is the most important component that we're going to discuss here today. Forward points typically have the greatest weight among the 6 components. But don't worry, we're going to go deeper and explore in more detail in the next slide. Execution costs, the third box here. These are the fees tied to the infrastructure and operational costs of the counterpart responsible for processing the transaction. Markup costs. These are additional fees charged by the provider for facilitating the hedge. Credit costs, this box here. These are the costs associated with margin requirements or credit lines. Again, this is another critical components. It's super important to understand. But don't worry, Albie, that is here today, gonna explore in more details and gonna take a closely look at in the upcoming slides. And finally, the cost of opportunity, often mentioned as cash drag or collateral drag. This is the capital tied up during the hedging process. Again, later we also delve deeper into the trade-off between credit costs and cash drag to better understand how to optimize these components. So the idea of this slide is that by breaking down these 6 components, we can uncover ways to manage and reduce the hedging costs effectively. Let's explore them further, as I mentioned. So let's dig into the forward points. 40 points, as I mentioned, reflects the interest rate differential between two currencies. Now, we often refer to them as the hedge impact or carry as well. As you can see in the chart, there is hedge impact. You often come across as carry, as I mentioned. So this chart on the right-hand side shows the hedge impact for the Brazilian real against the USD in the last 5 years. You can see on the x-axis the tenors. In other words, how long to hedge: 1 month, 3 months, 6 months, 2 years, up to 3 years. We have here in this chart. For each tenor, this chart shows the maximum here in red, the minimum in green, the 1 year ago, and the currency in blue, the values for the hedge impact. In other words, the values of the carry in annualized terms, so in an annual basis. Okay, so what is the first key takeaways from the chart? These values can vary significantly. So we can see here for 1 month, the annualized interest rate differential is 4.6. For the 3 months is 5.3. For 1 year is 6.7. 3 years, 7.5. So they can change, they can vary significantly across the tenors. And another key takeaway is that this carry don't always follow a linear path. They may have upward trend, they may have a downward trend, but it's not always linear. Okay, so because this is not linear, this chart is extremely insightful to understand the 40 points dynamics in order to reduce the hedging cost. So let me give an example. So if the hedger is long dollar and short BRL, he needs to avoid the adverse hedge impact. In other words, he needs to choose a maturity that has the lower interest rate differential or lower forward points. So let's give another example. So to materialize this conversation, most of the time in the discussions with our clients, we always, all the discussions are around what are the advantages and disadvantages of implementing a monthly, quarterly, or semi-annual rolling hedging programs versus long-term hedges. So in the end of the day, the discussion is about short or long-term hedges. So and based on the chart, we can take a lot of insights to decide and take a more informed decision. So in the end of the day, we need to assess all scenarios to decide what will be the best tenor to book the derivative contract. Super insightful, very hand tool. A part of the previous chart, one of the key tools in your platform, in your technology that I described early, helps our clients to optimize forward points. Now, of course, that the previous chart helps as well, but this tool illustrates it's very straight. This tool provides insights for any currency pair, displaying the forward rate and the annualized carry. Additionally, it shows whether you are buying or selling the basic currency and highlights the overall hedge impact. Let me give you an example. If I'm selling euro, as you can see here, I'm sold euro and buy USD, the interest rate differential is favorable as received here. The tool shows that 1 month tenor offers the lowest carry pickup as 1.52 here. It's in red color because the lowest value, while the 2 years provides the greatest, the higher pickup at 2.10. So because that is in green highlighted here. Let's take another example. Let's get here the COP, which stands for Colombian peso, and USD. So here I'm selling COP and long USD. In this direction, the hedging, the interest rate differential represents a cost. The 1 month tenor is the most expensive tenor. So here the hedge would pay 5.73, while the 1 year here is only 4.74 cost. So choosing the right maturity, choosing the most favorable one or the less costly one, you can optimize your hedging costs. So this to help you to choose the most cost-effective maturity for your derivative contract, regardless if it is a forward, an ETF, or option contract. That being said, this tool simplify the decision-making process by helping identify the most suitable maturities, as I mentioned before. That's wrap up my session of the webinar. Thank you all for your attention. Now I will hand it over to Albie Manderson, who will take you through the next topic. Over to you, Albie.
Thanks, Matheus. So now with forward points under our belt, we can move on to the next stage of the process, which is optimizing your ideal hedging strategy. So if you go next slide. So if we open our textbooks to page 134, we'll read an age-old wives' tale, the unbiased forward rate hypothesis. So it's an academic theory that holds that forward rates are an unbiased predictor of the future spot rate. So that means maintaining an expected return equal to 0. But through empirical evidence, we know this not to be the case. Forward rates are indeed biased. So instead, forward rate bias showcases the tendency for forward rates to overshoot future spot rates, in essence, making it more probable that not to roll the dice and achieve a better rate by not hedging or by under hedging. But what if that's simply not an option for you? Currencies are too volatile, you've been burned in the past, investors are at your door with pitchforks, you can't take this bet. Well, then you might want to consider turning to other hedging strategies, toss the forwards out the window and try options. Next slide. So how do we optimize a hedging strategy? Well, first, we have to know how options are priced. So total hedging cost of an option is equal to intrinsic value, so your moneyness, your in the money, out the money strikes, plus extrinsic value. So think your premium, so a combination of time value, implied volatility, and interest rates. So a common misconception here with prospects and clients that Diaglo speaks with is that when it comes to pricing options, the upfront premium is the only cost when it comes to hedging. False. Clients are very eager to lower the upfront costs and take whatever strike to achieve this. And as our graphic there, the mousetrap says, there's no such thing as a free lunch. So that being said, it's so important to take into account that if push comes to shove and you need to execute at whatever strike price, then was there ever any point in being hedged in the first place? Maybe it satisfied a loan covenant or an IPS agreement, but your foreign investors are going to feel that pain. So we drop down to point 2, the relationship between strike prices and premiums is non-linear. So implied volatility indicates demand for insurance, so takes into account the market sentiment, leading to volatility, skews, and smiles. So with all that in mind, we now know that optimization is possible and therefore necessary. Next slide. So keep in the back of your mind, when implied volatility is less than historical volatility, you get cheaper options. But when you wait to the last minute to hedge because implied volatility has spiked, you're going to pay for it. Just like how you don't want to be buying Christmas presents after the shopping malls have put their decorations out. No, get them at Black Friday sales. Hedge early before the market makes you pay for it. So take USD BRL on the left-hand side of the screen. Volatility 1 year at the money. What does that mean? So we're looking at implied volatility here, dropping down substantially from 2022 when a number of political, economic, global market conditions were running rampant. It was the election between Bolsonaro and Lula. GDP growth was sluggish. The Fed was hiking rates. Inflation was going crazy. People wanted insurance against the BRL. Remember that Christmas presents analogy. The ability to lock in a USD rate caused FX calls to be extremely expensive. So now 2024, those fears have subsided and the implied volatility on FX calls has dropped off. So we look at the right-hand side of the screen, USD Mexican peso, implied volatility has spiked in 2024, likely due to presidential elections, Trump coming to power, along with his tariffs, creating uncertainty around trade agreements. So one coming to mind would be the fact that Mexico's export market, 80% of goods are exported to the US. How is the Mexican peso going to cope with all this? People want insurance, causes implied volatility to spike. So next slide. So taking what we now know about implied volatility and the non-linear relationship between intrinsic and extrinsic values, we can start building some option strategies, the fun part. So I've done a quick option strategy simulation here using Diaglo's platform to see how some option strategies can improve the foreign currency exposure of a future transaction that goes about selling BRL and buying $1 million US 1 year from now. So on the left-hand side of the screen, the gray violin chart, you can see a distribution ranging from negative 400,000 up to 350,000. So this indicates your gain or loss on an unhedged exposure. Think of it like a textbook normal distribution flipped on its side, the width indicating frequency of outcomes. So with that in mind, we can look across the board. So you can see that we have a very expensive forward contract, as we discussed earlier, a call, so an option to buy US dollars, a collar and a seagull, which is like a collar with another short leg to offset the price even more, which gives us a lot of downside exposure, as you can see with that blue spike. This is also our cheapest strategy here in terms of upfront cost. So the seagull has the highest mean value indicated by the little black dot in the middle. There you go. But also the riskiest distribution of outcomes, that tail risk, as we just said earlier. So the next step is to choose a strategy that takes into account our aversion to risk and then optimize it. So do we prefer a high mean value, a lower volatility of outcomes, or a cheaper upfront premium? So next slide. So as you can see, I've chosen the seagull here because it had the highest mean among the strategies on the previous slide. And my pretend client has some leniency toward downside risk. So by exploring strike prices, how it affects the strategy's distribution, we can play around with the inputs and optimize it to a mean and variance that represents our risk aversion. The next step in optimizing the hedging costs is to investigate the margin requirements of our hedging strategies. What we are looking at here is another of Diaglo's platform tools, and for those clients with liquidity constraints at the front of mind. So again, we use a Monte Carlo simulation to forecast distribution of future spot rates, and then we use that to assess the net mark to market of each strategy. So the higher the peaks on those violin plots, the larger the distribution of expected net mark to market values of each strategy. So here, the forward is the most liquidity intensive product and the call being the least. So nice balance might be the seagull right at the end there. So some clients are less averse to large margin calls. So these would be our corporates with reoccurring cash flows, and others are more averse to large margin calls. So these would be our investment funds with fully invested portfolios without the ability to call upon more cash to top up their margin accounts. Next, there we go. So now that we have the interplay between mean, risk, and margin requirements sorted, we can now focus on the next step of optimizing a hedge strategy, the broker costs. So here we're looking at a diagram of best execution and trade allocation. So what this diagram is showing us is that when selecting a broker to execute our hedging strategy, we need to prioritize the trade-off between best price, meaning the spread that you're charged on the product that you're purchasing, whether it be a call or a put, and the liquidity optimization being the margin requirement. So think your initial margin and your variation margin. Now, assuming we're an investment fund, looking for the lowest margin requirements possible, we're going to want to take a walk down the right-hand side of the flowchart. So prioritizing lower collateral requirements at the expense of higher spreads. We also recommend our clients to weigh the difference between onboarding with an offshore and onshore counterparties, depending on your jurisdiction, can be very expensive in terms of pricing, and collateral requirements to turn a blind eye on this. So counterparty diversification is also a must, so you can shop around when searching for your best quote. It's best practice to not stick by the same broker deal after deal, as there might be a better one just around the corner. That brings us to our last slide, credit costs. So we have our strategy, we know its margin requirements, and we have our ideal broker in mind, whether that be onshore or offshore. And so what's left? Your last consideration, at what level to hedge at? So fund level hedging allows the fund to execute any hedging program independently of where the foreign investment is located. It's the same thing when buying your first home. Banks much prefer when you have mum or dad as your guarantor. The fund level hedging provides a significant improvement in creditworthiness. SPVs do not. LPs allow counterparties to face investors directly and enable managers to access credit-intensive lines more effectively, properly optimizing the usage to investor commitments instead of posting unnecessary margins that drag down the performance of the fund. So not only does fund level hedging get you tighter pricing, it also allows you to defer losses through tactics such as historical rate rollovers. SPVs, on the other hand, you're looking at steeper markups and even cash settlement. So that would be your last consideration when optimizing your hedging costs and hedging strategies, and also brings us to the end of the webinar. So that brings us to the Q&A session. So if any questions came up, feel free to ask those now. Otherwise, thank you very much.